This is the last day of the term. Next week, I will be here. I will only be here. No new material. This is the last test. The last test will be chapter 7 and 16. 17, sorry. But I'll be here if you have any questions, if you have any things you want to go over, if anything you want to clean up, or missing assignments and that sort of thing, you can tune in and be here. But anyway, so I will be here next week. I will not be covering new material. Today will be it as far as material going over. Question on that? Let's see here. I need to pull up my. I need to pull up my. What am I doing here? Chapter 17 handout. All right, and let's make it so you guys can see what I'm looking at. Okay. So audit report. So this is after you get all your evidence together and you formulate an opinion. And you're basically, is the audit report, is it are the financial statements reliable? Can we rely on the financial statements? Are they fairly presented? Are they, reasonable assurance, but whether they're free of material misstatement? That sort of thing. Okay, and I think I talked about this before. I think we had this earlier, something similar to it. But so we're going to first go over the AICPA, the non-issuer report. And this, when we pass the CPA exam, this is the report that you can write. And I think I told you guys this before, maybe I didn't, but the report must be in this format. You can lose your license if it's not. So this is a standard kind of boilerplate report. This is what they would call an unmodified report. In other words, it's not, there's no bad things happening with it. And it starts right out with the opinion. So the first thing is the opinion. And this is a clean one, so we'll say, in our opinion, the company financial statements present fairly in all material respects. Again, we throw that in there, like, we don't look at everything, it's not down to the penny. Financial position, this is the balance sheet. Result of its operations, that's the income statement. And cash flows, that's statement of cash flows. In accordance with accounting principles generally accepted in the United States of America, and that's just GAAP. All right, so that is the opinion. It starts out the report with the opinion. And now we talk a little bit about our, what was our basis for our opinion? And that is probably the biggest one here is we conducted our audits in accordance with auditing standards, not accounting standards. So accounting standards are in the opinion. The basis for opinion has auditing standards. CH17 of the United States of America. Okay, and it goes on for responsibilities. I'm not going to go on and read this. I think we did this before. Here's something that's kind of new. Key audit matters. CAMs, as we like to call them. There's actually two CAMs, so we'll talk about that later. Key audit matters. Whenever you're doing an audit, a lot of times there are things that you're worried about. There's things you have to consider. And so Key Audit Matters is something that is fairly new. I think it was added maybe 3 years ago, 4 years ago. I can't remember. But anyway, it's there now. So Key Audit Matters, and you can be engaged to report on Key Audit Matters, and you can also be engaged not to report on Key Audit Matters. But Key Audit Matters are those things that are sort of important that you can put in the audit report to tell people, hey, by the way, look at this, and whatever they are. It could be any number of things. You could, for instance, like let's say they have a large customer, but by the way, they're 80% of their business goes with this customer or whatever it is. So anything that's in a key audit matter, you can put on the end of the report. And again, we'll talk more about specific ones that we can put on there too. But those are things that are fairly new, and it's kind of there to give a little more information to people reading the report. Rather than just saying, good or bad, it says, oh, by the way, in this case, financial statements can be relied upon. Here are some things you should know, that sort of thing. Signature of the audit firm. City and state where it's issued. Oh, date of the audit report. This is the last day of work gathering evidence. Oops. So if you stop gathering evidence on February 3rd, whatever, that's what, that would be the date of your audit report. So it's the last date that you're gathering evidence. And the general rule is you're not responsible for anything that happens after that date. So, if you wrap this up on what did I say, February 2nd? So if you wrap this up on, say, February 2nd, 2024, and something happened on February 21st, you're not responsible for it. Okay. So that is the, that's for issuers. And again, this is when you pass the CPA exam, this is what it gives you the ability to do, write this report. And it has to be written this way. Everything in there is loaded. So yeah, you have to write exactly like this, or else you can't lose your license for doing it. When I was going through, they used to make us write it sometimes. They'd say write the standard audit report. They don't do that anymore. They've lengthened it. It used to be 3 paragraphs, honestly, 6 paragraphs or whatever it is. But anyway, they used to we used to have to memorize it. We write it out. But the audit report it's required, and only people who are licensed can actually write it. No one else can actually take that audit report. It's only people who are licensed can actually write it that way. So if someone thinks that they can do an audit without being a CPA and use that report, they can't. They're actually, they're auditing without a license. Now, there are other reports by the AICPA that are not required by the state, that aren't under the license. People think, well, I can use that report then, because this isn't an audit report, it's a whatever report by the AICPA. The AICPA has those copyrighted, and they're very diligent about going after people that use their report. It's copyrighted material, and so even those things that are not audit reports are protected by copyrights by the AICPA. And a lot of those are required by the states too. Okay. Let's go to the so this is a little bit of a difference here. It's unmodified for, try that again. Learning how to use a computer. So again, it's an unmodified report for the non-issuer. For the issuer, actually I should probably make this green. Let's make this green. It's called an unqualified report, which I know sounds a little bit odd sometimes, but unqualified means there's no qualifications on it. So a qualification would be like, for instance, let's say that my neighbor's complimenting me in my lawn. Well, other than your bushes over here, your lawn looks great. Well, that other than your bushes, that's a qualification. It doesn't just say your lawn looks great. He says, okay, other than that, that's a qualification. So when we say it's unqualified, there is no, other than this. It's these financial statements can be represented fairly. Okay. Again, pretty much starts out similar. Opinion on the financial statements, basis for an opinion. You'll notice something. They also have CAMs, but they're different. They have different CAMs. Their CAMs are not key audit matters, they're critical audit matters. Yeah, so, yeah. So critical audit matters are communicated below are matters from the current period audit that are related to accounts and disclosures to the financial statements and involving especially challenging subjective judgments. It does not alter the opinion on the financial statements. So we're still giving them a clean audit. We're still saying, hey, free of material misstatements, that sort of thing. But we're also saying, look, there could be some other things you should know about. And these are just some of the list of things that could be accounting estimates, risks of significant risks, not beyond normal risks. Normal risks are not in there. Judgments, nature and timing, and unusual transactions. You can read through here. But these are all things that come up in an audit that you may feel like they should be disclosed. And the people reading it should be known. Again, it's to give them more information on it. Now, remember these issuers. These are usually big companies. A lot of people, a lot of big investments on it. Banks investing, all these other people. The market relies upon accurate financial statements and all that kind of stuff. So it isn't the same thing as key audit matters for the issuers. You may be doing an audit report on a family-owned restaurant, and anything that's in there, the key audit matter, they probably already know. They're probably the ones that told you. So there's not too much, and there may be a bank or so relying on it for their loan or something like that. But usually it's not as important. When we get into publicly traded companies, sometimes you're talking about astro bucks, like billions of dollars. So when it comes to these critical audit matters, they get a little bit more involved. You have to identify the matter. What are the considerations of it? Reference what happened with it. What are the disclosures that you actually did with it? And then explain how you addressed the audit. What was your thinking basically for these items? And the rest of this stuff is pretty much the same. There is a little bit of a quirk in it, in that you must also say how long you've been their auditor. And you'll find some companies that it's kind of cool, because they'll say we've been the auditor since 1910. I mean, think about how many people have lived. That's before we had world wars. I mean, it was like very way way back. So sometimes you'll have people that have had the same auditor for over 100 years. Okay. A couple questions. So unmodified opinions, unqualified, clean. Okay, so let's take the standard report. The standard report for a non-public company is all the following except. This one's kind of tricky. You want to throw a guess out? So which of the following would not be on though? Anyone? You guys sleeping? You can put in private chat. Oh, come on, this is the last handout. Say anything. We can just keep going. No one? I'll tell you what. I'll redo some of it. We do talk about manager's responsibility. So that's not one of them. We do give an opinion on the financial statements. So that's not one of them. And we do have to get sufficient audit evidence. Hold on, wrong thing. There we go. So it's B or C. Oh, I got two in chat. Yay. Yes and yes. So C. We don't give an opinion on the internal control for a non-public company. The audit, actually, even for a financial report, we don't do it for the public one either. But yeah, so, and you recall that we had that the discussion on the test of controls. We said only if you rely on them, you don't have to test them unless you rely on them, and that's because you don't make a report on the internal controls. The report is on the financial statements. And the internal controls might be terrible, but if the financial statements are correct, then we're, you should say correct, but fairly presented. So we don't give an opinion on internal control. Okay. The standard report for public issuer. You know what? I realized I didn't talk about this one enough. I'll tell you what. So this is a publicly traded company. I'll give you the ones that it isn't. So we do talk about management responsibility. That's always there. We give an opinion, and publicly traded companies have accountants registered with the PCAOB. You have to be a registered CPA firm. So So we're down to B and C. So which one of these don't we probably have? No one has a coin? Oh, come on. I'll tell you what, let's take a look-see at it. All right. Well, I just gave it away. So the PCAOB standards are on there. So the ones that what is not on there is this one. They do reference the PCAOB. The AICPA standards they don't use. They use the PCAOB standards. And so you see the basis for our opinion. We conduct our audits with PCA. If you go back up here to blah 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 blah, we conducted our audit. With the so these are the AICPA standards. Okay. Okay, unmodified opinions with additional financial statement related matters. So these are things that we tack on to unmodified opinion. So these are still clean opinions. Okay. Oops. Yeah, I left out A in here. Okay. These are still clean, unmodified opinions. The emphasis of a matter are to items that have already been disclosed. So emphasis of a matter are things that are already been disclosed. It might be in the footnotes, it might be in the financial statements, but they're already disclosed. All right. So let's go over, and these are some of the ones that we're gonna talk about. All right. Going concern. I think we talked about this one. I can't remember. Okay, a going concern opinion is given and a client will likely go bankrupt. And this is to kind of close up a expectation gap. So expectation gap. All right. So what do I mean by that? So going concern opinion. All right. So here's what happened in the past. A company's going bankrupt. They put out their financial statements, and the financial, all kinds of losses and all kinds of bad, notice that a company going bankrupt can still have, uh, you know, financial statements that are appropriately prepared. They can still have, they're going to look bad. They're going to look like a bunch of losses and stuff, running out of cash or whatever. But a company going bankrupt can still put out financial statements that are free of material misstatement. So here's the problem that happened. So auditors come in, take a look at the financial statements, a bunch of red ink, bunch of losses, and but they are put together. They're not materially misstated and they're fairly presented. Auditors give them a clean audit report. 3 months later, the company goes bankrupt. Okay. You have the people, the public saying, how come why did the auditors give a clean audit report to this company that just went bankrupt 3 months later? How can that happen? They get a clean audit report and then they go bankrupt. The audit report has nothing to do with how the company's doing. It's basically it's basically out of the financial statements fairly presented. But there was this expectation. Now, when we do an audit, we don't say it's a good investment. Never. Even a company that's run very well. We never say this is a good investment. For instance, let's take Walmart. I'm sure, profitable company and all that. Are they a good investment? We never say that for a number of reasons, but not the least of which is it depends on how much the stock price is. Even if they're run well, if the stock price is way too high, it's not a good investment. So we never put a stamp of approval saying this is a good investment, but that's a little bit what the public wanted. They say, look, we want to know, so that's what this going concern paragraph, and these are big nowadays. What these going concern paragraphs are doing is they're saying, okay, is it likely that this company is going to go bankrupt? Now the question becomes, what's the period of time? In the past, it was always within a year. Now it's changed to be at least a year. So they have to project out at least a year. International standards are 2 years, but US standards can even be 2 years, 3 years, or what, but it has to be more than a year out that they have to consider. So let's put this in. So, okay, so let's put some of the things that we need to know for this in. Oops. So it has to be at least a year, and could very well be more than a year, 2, 3 years out. Okay, 2. The auditors may consider management's plans to avoid bankruptcy. So even though they're doing poorly, if they have a plan, in place, it's possible that you don't give them a going concern. there was an airline, a small airline they got a going concern opinion. And they came down saying, well, we disagree with our auditors, that we're not going, here's what we're doing. We're selling off these routes. We're cutting this, cutting out this line. We're selling these assets. And the auditors responded, if they had that in place when we did the audit, we wanted to give them a going concern. Sometimes it's a wake-up call. Companies don't realize you're going bankrupt until the auditors say, by the way, you're going bankrupt. You're going to be out of cash, within the next 9 months or whatever it is. Okay. And this is the one that's kind of new, but maybe, maybe it's not new anymore. Maybe like 7 or 8 years old. The client must put a going concern Okay, so the client must give no, I'm making up New York. See, these other lazy teachers, they don't make up their own, they just use all these old words that have been around for a long time. I make up new ones for you guys. Okay, so the client must put a going concern disclosure in the footnotes of the financial statement. So this is one of those things, the client actually has to put it in the footnotes that they possibly could be going bankrupt within, whatever their time frame is. It has to be at least a year. The time frame, this scenario. But so it will be disclosed. That's why this is a emphasis of the matter. It'll be in the footnotes. But we'll emphasize it in the report. Any question on that? Now, again, this does not change the audit report. They're still given a clean report. It's just this is tacked onto it. Because if their financial statements are fairly presented, it's fine. I think I'm leaving out something. I can't remember what though. If I think about it, I'll go back. Okay. Gap. So this is so to be clear, these are not misstatements. These are when they go from one accepted accounting principle to another. So I'm just making this up, but LIFO to FIFO. Can companies do that? Yes, they can do that. Sometimes the auditors will tell them, you need to do this. If the rest of the industry is using LIFO and they're using FIFO, whatever it is. So changing from one to another. Or, look at my little fingers. Or, if they go, if a new accounting rule comes out, a brand new accounting rule comes out that everyone has to follow. All right, well, they weren't following it last year, so when they come to this year, it's not consistent because the rule wasn't around last year. So if it's not consistently applied, it could also just be a new accounting rule that comes out. So these are not that, these are fairly common. I saw an audit report that had 6 of these one time. They had a whole bunch of changes one of the years, and they had 6 accounting rule changes tacked on to the end of the report. I remember the report was like, like 5 pages long because they had all this stuff, and they have to tell what the impact is on the net income and the balance sheet and all this kind of stuff for each one of them. So anyway, yeah, so it's changing from one GAAP rule to another. Again, it is not that they're not using GAAP. They are using GAAP. They're just changing from one GAAP rule to another. That is an emphasis of a matter. Those will be put in the footnotes. We changed from LIFO to FIFO or whatever it was, and we'll emphasize that in the audit report. It's just a paragraph that's tacked on to the audit. The audit report. Question on that? But again, it is not anything bad. It's just simply going from. So it could be, say, LIFO to FIFO. It could also be an old rule new accounting rule comes out, while the old one, I assume was different, or else it would be called a new rule. So yeah. So these would be sort of like the sort of examples. Okay. So emphasis of a matter, additional emphasis of a matter situation. These are discretionary ones, so that you do not have to, but you may put these in. These are usually big things. For instance, is risk of uncertainty. These are not usually your normal risks. I'll give you an example. If you manufacture cars, a certain number of people are going to crash the cars and be killed or injured or whatever. You're going to have lawsuits because of these car crashes. It's just part of being in the car business is there's going to be car crashes. I mean, it's always been like that for 100 and whatever years. You do not, you generally don't put stuff like that into the emphasis of a matter, because while it is true, everyone who invests in automobiles knows that there's this liability out there for people, whether it's the people driving the cars that are at fault or the manufacturing or whatever it is, that there's this liability out there, and it's pretty much the same for every car manufacturer. So that would be a normal risk of being in the car business. As ugly as it is, I mean, that is what one of the risks of it. Now, you don't report on that usually. Now, if there is a specific risk that is more than what you would think it would be, then you put it in. But generally speaking, for like normal risks of the business, you don't put those in. Okay, the company is a component of a larger business, so it's owned by somebody else. Significant events, whatever those are. It could be natural disasters. It could be, maybe the government made one of their products illegal, or big law, whatever it is. Accounting matters affecting comparability. For instance, let's say that they went on a building spree and they've built 5 new factories. They've doubled their production in the last year or so. You might put that in there and say, look, by the way, this company is way bigger than it was a year ago or 2 years ago. It isn't that they've changed methods or anything. They're using the same methods, but it's a much bigger company. Maybe they've taken on more debt or whatever it is. The accounting rules haven't changed, but the financial statements, having a company that's twice as big or whatever, comparing the financial statements is a little trickier. Okay. This is just where it's put in there. Okay. Other matter, paragraph. This can be almost anything. The auditor is somewhat free. You know what? Let me change this. Undisclosed. I'm sorry. Auditor is free to add significant undisclosed groups that are appropriate for the audit report. And I'll give you an example. The client bought a large. I got an extra T in there after year end. Now, notice that before year end, they didn't have it, so the financial statements would be without it. So afterwards, they bought this large competitor. They may have that disclosed in the financial statements, they may not. But if they don't, you may say, by the way, they bought this large competitor, so look out next year. This is going to be a different company, basically. Okay, so I think we'll do a couple of these, and then I'll send out the chapter 7 multiple choice. We'll take a break and come back and work on those. But let's go through these multiple choice questions. Okay, emphasis on matter. A going concern opinion has all the following except anyone? Oops. You can put it in the chat if you want.
Is it C?
Actually, you do use substantial doubt. The one that, and this is the new kind of newer one, is that it is not within 1 year; it's at least 1 year. So this is it should say at least 1 year. It could be 2 years, 3 years, 4 years, whatever. The old rules were within a year. The new ones are at least a year, and it could be 2 years, 3 years, whatever. International standards, they say 2 years. And I think that's kind of, it's one of those things that's kind of probably settled in is it's 2 years because the international standards are that, and we're trying to kind of, have apples to apples when it comes to them. Okay, emphasis of matter paragraph that's issued for generally accepted accounting principles not consistently applied has which of the following characteristics?
A?
Actually, A is a, I didn't tell you guys this, but change in accounting estimates do not count as a change in accounting principle. So for instance, if you had a straight line depreciation, you're depreciating this calculator. Over 5 years, you go, wait, this calculator is going to last for, it's going to last for about 10. That's a change in estimate. You might, but you'll still be depreciating it using the same straight line method or whatever. So the principle hasn't changed, the estimate has. So we're only talking about the changes in principles. It's a big distinction though that I should have made.
So is it D?
Yeah, yeah. There's nothing wrong with it. It's a let's see. Yeah, these are they're very common, first of all, and yeah, even if management has justified the use of it, or maybe they're required to use it, they still get it, and it's just basically to tell the reader, hey, heads up, this is a different accounting rule than you're used to. Okay, other matter paragraph issued uncertainties which have the following characteristics. So other matter uncertainties, those are things that are, well, uncertainties by definition means that you don't know what the exact the impact is on them. They may have difficult to get dollar amounts on them, but and they're generally things that are not, when it's other matter, these are things that are not already reported. So what kind of things do you think you put in there?
C?
Yep. Good. Yeah, you put in unusual ones, things that they wouldn't, that you may think are important, but they're not disclosed. Yeah, and things like this, if they could be reasonably estimated, and they're not uncertainties. And there's a few things in here, but they're not required, and they're not the normal uncertainties. So yeah, it's unusual ones. Uh, Other matter paragraph issued for additional circumstances may include all the following except. I don't think did I break those out in here? Oh, I did. Oh yeah, here we go. So which one of these could not be or should not be a other matter? Usually these are big things. So what on here doesn't look like a very big thing?
B?
Yeah, this is if you had a problem, if part of the inventory could not be verified, determine whether it's material or not, and that goes in the audit report if it is material, whatever. But if it is not material, forget about it. And just because it could not be verified, you generally don't put that in other matter. This is usually for big stuff, important subsequent events, major catastrophe, related party transactions. Those are all things that might be important to investors and so on. Okay, let's stop here, and I'm going to send out the yeah, I'm going to send out the multiple choice questions. Chapter 7, multiple choice questions. Oops. So you can go ahead and take a break, and I will have these coming out momentarily. Oops, nope. Okay, so I will say come be back at yeah. Oh, and I gotta put the what's going on here? All over the place. What's that doing? I'm sorry. Oh, I know why. I clicked on the wrong thing. Let's try that again. There we go. So be back at well, let's say 7:10, and I'm going to send and I'll put the multiple choice review up, or the poll for the multiple choice. I didn't talk about this one. I'll give you the answer to this one. Okay, I'll leave the pull up a little longer here. Okay. Which defined function should not be assigned to the accounting department? Okay, we're record keeping. So accounting is record keeping. And C is correct. We do not, payable checks are cash. That's money, and we should not be handling it. Very good. Which of the following is least likely to be considered a benefit? Yeah, we can't eliminate. Be nice to, but you know. Which of the following is correct? The first one. We do not contact regulatory agencies generally in accounting or auditing. We have a fiduciary duty to the client. Sometimes we may have to. Okay, fidelity bonds. Can I talk about these? The only thing I asked is that it's all over the place. Okay, minimize possibly. Yeah. The big thing about fidelity bonds, you guys got it right. The big thing about fidelity bonds is it's just insurance. It's insurance that if someone steals cash, that this company will pay whatever they stole. And cashiers are oftentimes bonded. Bank tellers are bonded, that sort of thing. But one of the real benefits of it are these companies, they want to minimize their risk, so they do background checks. And a lot of times these background checks will pull up people that could have had problems in the past. So this is what it is. Okay, Sarbanes-Oxley. The audit committee is responsible for employment compensation and oversight. And they don't, for instance, annually assess risks. This is management job. They do not use the CPA firm information. They use their own information. But yeah. Okay. Let's go to 6. Which of the following would be most likely to detect? Yeah, there's a limitation of internal controls. So this is the fraud in action of an individual. If it's just one person, a lot of times internal controls can catch it. The problem with these other ones is these can be, several employees collusion. That's when someone could make the transactions disappear on the books and cash disappear and all that kind of stuff. Deviations, you have someone doing things they shouldn't be doing. And management fraud, especially management override, these are all limitations of internal control. Yes, good. This is a tough one. Scope of substantive tests compared to scopes of test controls is inverse. I think this question was actually on the CPA exam when I took it. The few ones I remember. Ooh, 8 is a split. 8's a good split, and I'll definitely give it to you. This one's a tough one. And this one I didn't talk about. Maybe now's a good time. When they do an audit of internal control, here's what happens. A company is required to do their own assessment of internal control. The auditors come in and form an opinion of management's assessment of internal control. Okay, do they have everything? They don't have everything, and that sort of thing. One of the kind of ironic things about it is that the people that, Sarbanes-Oxley, the 2 people who made this and all the other rulemaking people, they assumed that companies were doing this. The companies were reassessing their internal controls all the time. No one was. So it was all very new. CPA firms had to go in and tell the client, okay, this is how you assess controls. Now you do the assessment of controls and we'll come back and audit it, So you actually do an audit of management's assessment of internal controls, and if there's anything left out and that sort of thing that you look at. But yeah, so you're actually doing an audit of their internal controls. 9. Under which circumstance is it likely to extend substantive procedures to expand beyond the yep. E. And 10. Test controls. Yep. Very good. Okay, well, that's all the points. I'm going to stop sharing just because I don't like sharing. I'm going to download this. All right, so this is, what week is this? Week, well, I was up with it. This is chapter 7. Multiple choice poll report, and we are fall. Oh, I know what I need. I was going to tell you guys. I'm got a blank screen here. Okay. I still have to add the extra credit points onto your chapter 5 and 6 exam. I haven't done that yet. So there'd be, I think it's 5 extra credit points put on there. Okay. Let's finish up the handout. And we've talked about these before. This shouldn't take very long. Okay. Qualified opinion. These are modified opinions. So these are ones that are not standard. So qualified opinion. Probably you guys could probably answer these. Qualified opinion is a qualified opinion that
Can you please share your screen?
yeah. This part of the Zoom meeting was just for me, by the way. Sorry about that. A qualified opinion is when a material misstatement exists let's take a look. But it is not pervasive. Usually it's when it's limited to one account, maybe 2 accounts. And the financial statements are generally considered fairly presented. I think we talked about these before. I'm positive we did. Probably early on though. Adverse opinion. Let me do something here. Adverse is when a material misstatement that is pervasive. This is the worst opinion. And they are very rare because there's no reason for them. They should alter, adjust their financial statements. Financial statements cannot be relied upon. Statement of opinion. Sometimes it's called a disclaimer. Then the auditors cannot get others cannot obtain enough evidence to form an opinion. So, for whatever reason, they cannot get enough evidence to say yes or no on opinion. For these two, the misstatement is unknown. Or excuse me, misstatement is known. Whatever it is, $10 million, whatever it is. So misstatement is known for qualitative, for an adverse opinion. Oops. Yeah, misspelled choice. How come you guys tell me that? So misstatement is known for an adverse opinion. For disclaimer, it's not known. So misstatement, if there is any, is unknown. And by the way, one of the reasons why qualified opinions and adverse opinions are rare is that it's going to go right in the report. Whatever, if they're misstating their revenues by $10 million, it's going to be right in that adverse opinion that it's off misstated by $10 million. They're not going to be hiding anything. And all it's going to do is make them look worse. So these are fairly rare if they're just simply correcting the financial statements. They're fairly rare. They happen, yeah. You get people getting all upset about something, and we're not changing this. Whatever it is. Okay. Which of the following misstatements result in a qualified opinion? By the way, qualified opinions are sometimes called except for opinions because they say everything's okay except for, and then they say the bad stuff. That's the qualification. Everything's okay except for inventory or whatever.
Is it B?
Yep. Yeah, there's a misstatement, but it's not. In the end, they'll say everything is okay except for, and then they'll go into what the misstatement is. But generally, the financial statements are fairly presented. Which of the following types of misstatements would generally result in a disclaimer of opinion?
D?
Yeah, any possible misstatements cannot be verified. So whether, good or bad, uh, a disclaimer really is nothing. I mean, it's like saying, it's like shrugging your shoulders or something. For whatever reason, my spacing got weird here. So okay, what's it? HI, if that's I or no. Which of the following types of misstatements would result in an adverse opinion? Oh, come on.
C.
Yeah. Yeah, pervasive. And part of the reason I put this on here is that to get used to that wording, pervasive, not pervasive, that's the kind of stuff that they test on, the CPA exam. And, this is their terminology. So get used to it as you can. Okay, scope limitations. Did I talk about these in the past? I thought I did. Maybe not. Okay, so scope limitations. These occur when you can't get enough information. Your scope, what you're looking at, you can't get enough of it. So it could be that you can't talk to their lawyer. It could be that they had a fire and all their accounting records got burned up. It could be, whatever it is. You don't have enough of a scope. You can't see enough stuff to form an opinion, or that at least it hinders your progress. Sometimes you might be able to do something different to confirm it, but whatever it is, a scope limitation is a scope limitation. And the question is, well, which ones are the more serious ones? And the more serious ones are so circumstance imposed. This is when something beyond the client's control. Fire destroys the accounting records. This is a fairly new one. We used to just call this the circumstance imposed, but there's a circumstance imposed due to the nature and timing of the audit. So this is, for instance, if they have the audit done at after year end. So these are both circumstance imposed, and both of these are beyond the control of the client. They can't jump in the time machine and go back and whatever. Client imposed is when the client doesn't allow you to get information that you need for the audit. This is the more serious of these. So the following is the most serious. This one. And it has to do with the fact that just in general, just human nature, if somebody doesn't want you doing, looking at something, there's probably a reason why. I remember my kid was little. There was like these cupcakes on the table. He turned to us and said, "Don't look at me." What we knew what was going to happen. Grab a cupcake. But yeah. So anyway, yeah. So circumstance imposed ones you give a little more slack to, because a lot of times it's out of the client's control. They had a fire. They wish they didn't have a fire, but whatever. But the client imposed ones, when the client won't let you see something. We don't want you looking at our inventory. We don't want you whatever. Those are more serious because that's immediately what you want to do. If someone says they don't want you talking to their lawyer, immediately what goes to your mind is, man, I really got to talk to the lawyer, because now there's a good reason to, because there's some reason why this person doesn't want me to talk to the lawyer. So that's, again, that when the client imposes a scope limitation, you generally take it pretty seriously. Okay. A scope limitation that is deemed to be possibly material and pervasive should give which type of an audit opinion? Okay, now remember, we're saying it's possibly. We're not saying that we found it to be, because it's a limitation. We can't determine whether it's, but it's possibly material and pervasive. What type of an opinion? I'll help you out. I'll tell you when it's not. It's not the adverse opinion. Adverse opinion means you know that it's misstated by a certain amount.
B.
B would be if it was not pervasive. It probably is B. And actually, you jumped ahead. This is where I'm going to talk about that next. This would probably be a disclaimer. It's possibly material. You don't know if it's material or not, but it'd be a disclaimer, and that's no opinion, and there's really no value to a disclaimer. So it's probably the second worst opinion to get, other than adverse. A disclaimer means here's nothing, and here's our bill. Okay, now this is where it gets a little bit interesting. Something that's possibly material, but not pervasive. Okay, so this is something that you should consider giving a qualified opinion for. A qualified opinion is actually better than a disclaimer. Qualified opinion means there's this one thing we don't know about, or there's one thing that's misstated. And in this case, we'll say, okay, we don't know about this. The financial statements can be relied upon, but we're going to give a qualification, except for this that we couldn't verify. We'll give this, assuming possibly that this material misstatement does occur, but it's not pervasive. Even if it does occur, it's not pervasive. And a qualified opinion is better than a disclaimer, because a qualified opinion says overall the financial statements can be relied upon. So if you're given the choice of here's nothing, or here's the financials, here's the financial statements with this qualification on it that, okay, there's this one account, whatever, inventory or accounts payable, whatever it is, that we can't verify, but everything else is okay, and you can rely on these financial statements. Well, that's what you want. You want this assurance. You can take it to the bank and say, yeah, they couldn't determine this, but everything else is fine. The cash is fine. Accounts receivable, whatever. Property and equipment's fine. It's a lot more information than simply a disclaimer, which means, I don't know. It's a little more eloquent than that, but it pretty much is. I don't know. All right. A scope limitation that seemed to be not material and not pervasive should have which type of audit opinion? So there's a scope limitation. We can't see something we want to see, but we find out it's not material and it's not pervasive.
A.
Yep. And that is actually, if this is not material, that's it. So there you go, standard cleaner form. Okay, so on the test, I'll get some stuff, probably mostly multiple choice for the internal control. I'm definitely going to put a going concern problem on there. So there'll be a going concern one where you have to know, and these are really big nowadays. Companies going bankrupt, or companies that are getting these sometimes. They're very very profound. And I'd probably throw something of these other ones on there. Certainly the types of opinions, I'll probably put something on there for these, whether it's a definition or more likely give a scenario. But yeah. Any questions? Okay, let me. Yeah, so I'll send out the chapters 7 and 17 exam tonight. It'll be due not for a while, 11 days. Is that right? Oh, okay. Well, you get it's not getting till Friday. You get till Saturday to turn it next Saturday, and then next week we will have. I will be at class, but it's only no new material. It'll only be for catch up. People that want to. Well, you're welcome to come. I know you guys like sitting still for 2 hours, but anyway, that'll be yeah. Any questions? Well, it's been great having you guys, and I will send out that test shortly, probably within an hour. I'll have the test out. Okay. Have a good evening.
Thank you.
Thank you.